I'm going to turn to the panel now and get a more granular look at how they see the economy, how they see the equity markets, how they see liquidity availability. Jay, why don't I start with you on that and have you comment a little bit on those issues.
Looking forward at 2010, it's hard to say that we're not going to have a better year than we had in 2009, since it's the worst year in recorded history for institutional investing. But we're bumping along the bottom as well, and I think that we look at our experience in our portfolio. We do have a large exposure to housing. We do feel that housing on both the for sale side and the for rent side will likely lead the way out of this recession. 2010 will be a period of transition. There'll be a lot of volatility in the housing market. We'll see additional foreclosures in the housing market because of defaulting loans that have been buoyed by federal programs. But those federal programs will fail in many cases. We'll have foreclosures, but 2010 will really be a turning point for us.
I would add that until we start to add positive job growth in the country, it's going to be a while after that before we'll see any significant improvement in the fundamentals in the real estate sector. So if we don't start adding jobs, let's say until the third or fourth quarter of this year, and then even at a fairly anemic rate, the likely recovery in the fundamentals in terms of occupancy and then ultimately rent growth probably are going to lag some 12 to 18 months beyond that.
We've seen a lot more liquidity come into the market at this time this year as we had previously from last year on debt, but at a lot more conservative values. Today there are several life insurance companies, even some foreign banks coming into the U.S. that are prepared to loan at 50% of values, today's values, which have been impaired probably close to 30%, sometimes more. If they're in very good markets, they're temporarily impaired. As if they're in tertiary markets or some secondary markets, we believe there could be some permanent impairment. But overall, I believe that values, for the most part, on the industrial assets in the prime locations have bottomed out. But it's going to take some time to recover on any valuations or increase in NOI, primarily because we've seen the highest availability rate, which means vacancy in all recorded time of many asset classes, but specifically industrial. And until demand picks up, and that has a lot to do with employment in the U.S., the consumer, we're not going to see any of that availability eaten up into. So that's going to take some time. But there are opportunities out there, but you have to really be close to the ground to find them. You're not going to be able to find them on a macro basis, and the country is very fragmented in its recovery, unlike the early 90s with the Resolution Trust Corporation and the S&L crisis, where the entire U.S. went up and increased through the recovery. Today, throughout the United States, different markets are very fragmented, whether it be in Northern California, Southern California, Detroit, Cleveland. You really have to understand your specific markets if you're going to invest there.
Let's talk about your existing tenants and their fundamentals. Are they weakening, stabilized, improving? How can you describe them at this point?
And again, I'll focus on the housing side. And job formation is, you'll hear jobs quite a bit. Job formation is extremely important to household formation. Household formation is the primary driver for a demand on housing. So again, we'll be relying on jobs, but we also have a fundamental shift in the population in the U.S. as well. That's another driver. Now, there's pent-up demand on the household side, on the formation side, because there aren't the jobs. So there are a lot of young people in this echo boomer that are living with their parents that are 2, 3, 4 deep in one apartment. But that will change with time. That not only will parents throw their kids out, and will, friends no longer be friends because they have too many people living in one area. But as jobs start to formulate, we'll see that household formations begin to grow. We do expect that there will be a peak demand for housing by 2012. So again, I look at 2010 as a transition period, but the demand from a population perspective, from a demographic perspective, is out there to drive housing.
Let's discuss a little bit sources of debt, types of debt. Who are the lenders right now? Types of loans that you'll be using. So Doug, you haven't begun the discussions. Why don't we start with you this time?
Yeah, in terms of the types of lenders that are active in the market today, it's pretty contained compared to where it was 3 years ago, where the CMBS market seemed to really, I won't say dominate, but was a major factor. CMBS, there's a few sparks of life in that sector, but it's relatively modest still. The sense is that it may come back at some stage, but it's going to take some time for that to occur as well. But where you're really seeing a fair amount of capital is from the life insurance industry, which has traditionally been a provider of mortgage debt to equity owners, particularly on the higher quality assets. And then also the banks are starting to become more active again as well, not only with refinancing their existing loan portfolios, but pleasantly, I've heard recently of a number of banks that are actually looking for new business. Now, all of these new programs, whether it be insurance companies or banks, are in very modest structures compared to where they were before. If you could borrow 75 or 80 or even 85% in 2005 or 7, today you're probably limited to no more than 60, maybe 65%.